meeting is being.
Okay, I think we'll go ahead and get started in lieu of time. So welcome everybody to part 2 of Secure Act 2.0 presented by Union Bank and Trust. If you didn't happen to join us for part 1, my name is Jason and I manage the education department here in Retirement Plan Services at UBT. Presenting, of course, today is John Nouns. John is a vice president and ERISA attorney, as well as a relationship manager here in Retirement Plan Services at UBT. And just a little bit of housekeeping here. We will leave time at the end for questions. So if you do have any questions, please hang on to those until the end. And if you utilize the chat box, which is wonderful, we will definitely get to all of those chat box questions at the end as well. Also, John's contact information, of course, will be posted at the end. But as always, feel free to reach out to your relationship manager with any follow-up questions that you might have as well, certainly. This is being recorded and it will be included in the quarterly plan sponsor email, as well as posted to the website as soon as it becomes available. So, before we hand it over to John, I am going to go through this, and I'm not going to read this. I'm certainly not going to read this disclaimer verbatim, but we want to let you know that the information that John is going to provide is intended just for educational purposes only. Neither John nor UBT is going to provide any legal, tax, or financial advice, just education. And that's what this disclaimer is just saying. It's we're going to give some information and not advice today. So with that, I'm going to hand it over to John.
Thank you, Jason, and welcome back to part 2 of Union Bank's webinar on the Secure Act of 2022. And as always, I want to thank Jason for his hosting duties as well as his technical expertise to make this happen. So we left off last week in 2024, so we're back in 2024. And so effective next year, there's going to be an increase in the mandatory distribution amount. This is optional. It's not required, but I expect every employer to adopt this provision. So here's a little bit of background on what's going on here. Plans really come in generally 2 flavors, a $1,000 cash out limit plan or a $5,000 cash out limit plan. This increase in the mandatory distribution amount only applies to those plans that use a $5,000 cash out limit. So again, a little bit of background. So if you've got a $1,000 cash out limit plan, what's going on is if I have an account balance that's greater than $1,000, the plan can't make a distribution to me unless I consent to that distribution. If my account balance is less than $1,000 in a $1,000 cash out plan, then the plan can just force me to receive a distribution without my consent. But if I've got a $5,000 cash out plan, if I'm over $5,000 in account balance, you can't force me to take a distribution without my consent. If I'm under $1,000, you can cash me out in cash without my consent. And if I'm between $1,000 and $5,000 account balance, I don't need to consent to the distribution, but if I don't consent, then the distribution will be made to an automatic rollover IRA. So that's what's happening here. That $5,000 amount can move to $7,000 next year. So that means in a $5,000 cash out plan, it'll become a $7,000 cash out plan, and any account balance between $1,000 and $7,000 can be cashed out, or rather forced out of the plan without the participant's permission, but it needs to go into an automatic rollover IRA. For those of you who still have merged money purchase pension dollars in your plans, as you know, that piece is subject to joint and survivor annuity rules. And so that would also be impacted by this increase from $5,000 to $7,000 if there's merged money purchase pension account balance less than $7,000, a joint survivor annuity would not have to be provided in that case. Next, again, remember our trends from last week, more distribution options. And here we've got emergency personal expense distributions effective 2024, again, optional, not required, and it applies to defined contribution plans but not any money purchase pension accounts. 403B plans applies to, as well as governmental 457B plans. And so the purpose of this distribution would be to meet unforeseeable or immediate financial needs relating to necessary personal or family emergency expenses. So it kind of feels like a hardship distribution, but we're going to see in a moment that it isn't in a couple of different aspects. And so a hardship distribution, as you know, we've got a handful of emergencies or immediate financial need events like paying tuition, buying a house, medical care, and such. Here, we don't have any guidelines at all, don't know if the IRS is going to issue any guidelines. And the reason why I say that is because, again, this is another self-certification situation. I can go into HR and say, I'd like my emergency personal expense distribution, and it can be made to me without me providing any type of documentation, unless the IRS somehow tells us we're going to need some documentation. But at this point, self-certification looks like it's good unless the plan administrator has actual knowledge to the contrary. And so what is unforeseeable or immediate financial needs related to necessary personal or family emergency expenses? Let's say that you want to require some sort of documentation. What does that mean? I don't really know. I've read articles and such like that, and the example that keeps getting brought up is that my car breaks down and I need to get it fixed. Well, that's an unforeseeable and immediate financial need. But what if, for example, I need a mental health week and I decide to go to Belize? Is that some sort of immediate need for a personal emergency expense? Well, I don't know. But again, I should be able to self-certify that and things will be fine. So we can't get a lot of money out of the plan for an emergency personal expense. And again, plans are not required to offer this distribution, but they may if they want to. It's limited to one distribution per calendar year, and the maximum amount that can be distributed under this new distributable event is the lesser of $1,000 in the calendar year, or the excess of the total vested account balance that's over $1,000. In other words, we can't receive a personal expense distribution that would cause the vested account balance to go below $1,000. So a couple of quick examples. I've got $10,000 vested account balance. I can receive the maximum $1,000 emergency personal expense distribution. However, if I've got $1,600 vested account balance, then I can only receive $600 in this emergency personal expense distribution, because remember, I can't take a distribution that would cause my account balance to go below $1,000 here. As I said, it looks like, I'm having troubles advancing the slide here. There we go. As I said, it kind of feels like it's a hardship distribution, but it's not. And you can clearly see that in these tax rules. So normal tax rules apply, just like a hardship. However, the 10% early distribution penalty does not apply, but it would apply in a hardship situation. Oddly enough, it looks like this distribution can be rolled over. It'll be interesting if there's some IRS guidance that says it can't be done, but it looks like it can be rolled over at this point. You must take it before a hardship distribution if the plan allows hardship distributions. Again, we touched on that last week when we were talking about disaster distributions, and I want to bring it up here again because this kind of feels like a hardship distribution, but it's not. But remember, if the plan allows hardship distributions, a participant can only receive a hardship distribution after he is or she has received all other available distributions under the plan. And we can see a trend here with these new distributable events is that the participant can repay this personal expense distribution back to the plan within 3 years. And interestingly enough, as I said, can only receive one distribution a year, but you get shut out from receiving another personal expense distribution for 3 years unless the emergency distribution is repaid back to the plan or the participant makes elective deferrals in an amount that is at least equal to the unpaid emergency distribution amount. And so we should think of this as a repayment of sorts, and we'll go through a couple of examples. So our first example is that 2024, the participant receives $1,000 emergency personal expense distribution, does not repay the distribution, does not make any deferrals after the distribution date. This participant will not be able to receive another personal expense distribution for 25, 26, or 27. So it will be in 2028 before this participant can receive another emergency distribution. Next example, same situation, except this time the participant does repay the distribution in 2024. That means our participant can receive another emergency personal expense distribution in 2025. A variation of this is that, again, we're receiving $1,000 personal expense distribution. We receive it on March 15th of 2024. Participant doesn't repay the distribution, but the participant does make $1,000 in deferrals from March 15th, 2024 to December 31st, 2024. Think of this as a repayment of sorts, means that the participant can receive another emergency personal expense distribution in 2025. So you repay it back, or you make deferrals equal to the distribution amount, or you're locked out from receiving another one for 3 years. Next, Roth up catch-up contributions. We're going to need a couple of technical corrections here, but before we talk about that, let's talk about what's going on. So last week, we talked about the so-called Rothification. Congress likes Roth contributions because that gets money getting to the government in the year that the contribution is made. So this is one of those provisions. And what this provision says is that beginning in 2024, if you have a participant with FICA wages that exceeds $145,000, and that amount will be adjusted for inflation going forward, for the preceding year, then that $145,000 participant, if he or she is going to make catch-up contributions, those catch-up contributions need to be in Roth dollars. Will no longer be able to have the option of making catch-up contributions in pre-tax dollars. Interestingly, and we expect technical correction to be here, is that this Roth only catch-up for these $145,000 folks doesn't apply to self-employed workers. So if you're an LLC member, or you're a partner and you're taxed as a partnership, or you're sole proprietor, and you're paying self-employment taxes, and your self-employment income is more than $145,000, unless it gets corrected, I think you can say that, well, that doesn't apply to me and I can do pre-tax. Well, that probably was not intended to only let only to require employees to make Roth catch-up contributions if they're over this $145,000 threshold. And so I would expect a technical correction here. Now, just for fun facts, earlier versions of this bill actually had all catch-up contributions being Roth, regardless of income, and other versions had it at the $100,000 cutoff rather than this $145,000 catch-up. It will apply to those 401k plans, 403b plans, and governmental 457 plans, which are the plans that allow for Roth contributions. So what if you've got a plan and you don't currently allow for Roth contributions, that pre-tax deferrals are the only type of deferrals that can be made. Well, if you've got one of these employees with more than $145,000 in compensation, well, those employees aren't going to be able to make catch-up contributions because you don't allow Roth contributions. So if you want those $145,000 folks to be able to make catch-up contributions at all, you're going to have to add a Roth deferral feature. And so these folks can make their catch-up contributions, which are required to be Roth. Workaround, I suspect, I don't see anything that would prohibit it unless the IRS tells us we can't do it. But a possible workaround is for administrative simplicity. I think we could probably design our plans to require all catch-up contributions be Roth, just like an earlier version of this bill. And so at least in that respect, you wouldn't have to worry about who's making more than 145,000 and who is not making $145,000. Now, we are also going to need guidance on really how's this going to work when we don't know we have a catch-up contribution. So, for example, if we're doing 401k non-discrimination testing and I'm a highly compensated employee and you're going to make a refund to me because the non-highly compensated employees haven't deferred enough, well, it's at that point, for example, if you were going to refund to me $2,000, well, rather than refunding it to me, it's just recharacterized as a catch-up contribution. Well, if that was originally made as a pre-tax contribution, well, now, well into the next year, when we do our non-discrimination testing, that's going to need to be a Roth contribution, but we only know it after the fact. So what do we do with reporting on W-2s? What do we do with 1099-Rs? And how do we just kind of do it as an in-plan Roth kind of transfer? Don't know. The IRS is going to have to tell us what we do about that. Again, that's required, not permissive, not permissible. It's required. But a major technical drafting error, in fact, when Congress was drafting these Roth only catch-up contributions for this $145,000 folks, they inadvertently killed the ability for anyone to make catch-up contributions beginning in 2024. So as we sit here today on March 29th, 2023, no one will be able to make catch-up contributions in 2024, regardless of income. You won't be able to make pre-tax or Roth catch-up contributions next year as the law stands right now. That's obviously going to get corrected before 2024, but a major drafting error in this statute. Next, these so-called pension-linked emergency savings accounts, or I've heard it referred to as sidecar accounts or Roth savings accounts. First of all, it applies to 401k, 403b, and governmental 457b plans. It's an optional feature. It's not required. And what you should think of this as, and you'll see as we talk about it, is this is really a Roth savings account inside of a retirement plan. And kind of keep that in mind as we go through that. So what Congress was looking to do here is that, in fact, the Senate summary of this bill cites a Federal Reserve report stating that nearly 50% of Americans cannot cover an unexpected $400 expense. And other studies show that in this type of situation, workers are then forced to cover that expense by dipping into their retirement accounts. And so what Congress hopes to do is to at least put a dent in that kind of situation by allowing savings accounts to be put inside a 401k plan. So a totally new idea. It is, again, it's a savings account within a retirement plan. Contributions must be made on a Roth basis, and they must be funded by elective contributions, cannot transfer money into this emergency savings account. So for example, let's say I've got some pre-tax dollars inside my 401k plan. I cannot elect to transfer from my pre-tax account into this emergency savings account. Now, if the plan allows for in-plan transfers, I can go from pre-tax 401k to Roth 401k. I just can't go from my pre-tax account to this Roth ESA or Roth savings account. There's going to be separate record keeping required for the ESA, and we'll see how that works. So again, plans are not required to allow for a Roth ESA, but they may if they want to. So couple of ways that an ESA can be established. First of all, it's only available to non-highly compensated employees. A highly compensated employee cannot have this sidecar savings account. And if a non-highly compensated employee becomes a highly compensated employee, then he or she won't be able to make additional contributions to the savings account, but will still be able to receive distributions from the savings account. The ESA, if it is offered in a plan, must be available to anyone who's eligible to participate in the plan. And the plan can be designed so the participant can make an affirmative election to establish the savings account, or the plan can be designed in a way that the employer can automatically enroll participants in an ESA and have it be automatic contribution arrangement inside this savings account. And again, remember, it is a savings account in a retirement plan, and that last bullet point on this slide shows it, is that it behaves like a savings account. It needs to be invested in some sort of cash or interest-bearing account or investment product designed to preserve the principal. So in other words, it needs to be invested in some type of money market fund or a stable value fund. Contribution limits, there's no minimum contribution limits in there. So you can't say, oh, you need to make at least $100 contribution to your ESA, but there are caps on what can be put in these savings accounts. And so the law says the contributions need to be capped at $2,500. It'll be adjusted for inflation as we go forward. The employer can set a lower cap. For example, you can't have more than $1,000 in there. Now, the account can exceed $2,500 with earnings, but no additional contributions can be made to that ESA if it will cause the account balance to exceed $2,500. So for example, I make a $2,500 ESA contribution, it grows to $2,550. No additional contributions can go into that ESA until it goes below $2,500 through distributions. Any contributions made to this Roth savings account is coordinated with the elective deferral limit. So if it's a $19,500 limit, anything that goes into this Roth ESA will be count against that. If there are any excess deferrals that need to be distributed, those excess deferrals will be coming out of the ESA account first. So what happens if we do have excess contributions? So for example, I've got more than $2,500 in my savings account. The account can't take any more contributions. Well, if the participant doesn't otherwise have a designated Roth deferral account in the plan, then the contributions must stop. If the participant does have a designated Roth deferral account inside the plan can be designed to allow for the participant to elect to increase that non-ESA Roth deferral election. So for example, let's say I have made a 3% Roth election to go into this savings account. I filled it up. It's over $2,500 or it's at 2,500. I can't put another dollar in there. I can elect to have that 3% ESA deferral election go to my Roth deferral account. Alternatively, the plan can be designed to say, if the participant doesn't make any election at all, so I think what you do is you provide the participant an opportunity to make the election. The participant doesn't make any type of election. The plan can be designed in a way for that 3% that I'm making to my Roth ESA deemed to have elected to make that 3% going into the regular Roth deferral account that's not the savings account. And why I said it looks, acts, and feels like a savings account, because I think it is. You can get money out of there quite frequently. In fact, the plan needs to allow a participant to receive at least one distribution per month out of these ESAs. It can be a lump sum or a partial distribution. And the first 4 distributions per year cannot be subject to fees. Any distributions after 4 can be subject to fees. Any distribution will be treated as a qualified Roth distribution. So kind of like a distribution, or rather I take a withdrawal out of my savings account. It's after-tax dollars in that savings account, but in addition to that, any earnings on that account will also be tax-free. It'll be like a qualified Roth distribution. There's no 5-year rule, and there doesn't need to be a qualified purpose, like for example, age 59, to get it out of the plan. I can get it out anytime, no tax, no 10% early distribution, again, just coming out of this Roth ESA savings account. Automatic contribution arrangement is permitted. In other words, if you do allow for these sidecar savings accounts, the plan can be designed for the employer to subject everybody, your non-Hileys only, to an automatic contribution arrangement that says, hey, unless you elect out, or unless you elect a different percentage, then we're going to take 3% of your compensation out and put it into this Roth savings account until it gets up to $2,500. Now, here's where things get a little tricky. Although it is a savings account within a retirement plan, if the plan makes matching contributions, then this is kind of looking like those student loan matching contributions that we talked about last week. So, for example, if you have a participant who's making Roth ESA contributions into that savings account, then matching contributions need to be made on those ESA contributions at the same rate that matching contributions are made on non-ESA elective contributions. So we've got 2 participants. One makes a 3% election to go into this sidecar savings account. The other participant makes an election to have 3% to go into his or her 401k account. In both cases, they will receive a matching contribution that is identical under the terms of the plan. The matching contribution is not made to that ESA account. It's made in the matching contribution account, whether it's a regular matching contribution account or whether it's a safe harbor matching contribution account. Order of priority. Now we've got the situation, a participant has made some contributions to this ESA and some contributions to the non-ESA 401k account. What do we do with our match? Well, first of all, we apply our matching contribution formula to the non-ESA deferral account. Anything left over, the matching contribution will be made on those ESA elective contributions. So what happens if we've got a termination? And a termination can happen in one of 2 ways. A participant terminates employment, or the employer decides to terminate the ESA feature. Well, there's a couple of options in these termination situations. The participant can transfer to a non-ESA Roth account inside the plan, or the participant can elect a distribution from the ESA account. Again, effective in 2024, permissible, not required, but there are going to be challenges in implementing these ESA accounts. First of all, we're going to need to track any non-Hileys that become Hileys, and that can because of compensation or ownership, and we're going to need to shut off those ESA contributions as needed. Also, we're going to constantly need to track that $2,500 cap or a lower plan limit if in the plan, and shutting off that as needed. Also, I suspect that because of this $2,500 cap, and you can get to that money at least monthly, that there's going to be a lot of times that we're going to fill that bucket up to $2,500, and then that election goes over to the regular Roth account. But then there's a distribution that comes out, bringing them back down to $2,500. So it's those dollars are gonna go back into the ESA account, and we're gonna keep kind of filling the bucket up. And when we fill it up, we switch over to Roth deferrals. Then when we draw that ESA bucket down below 2,500, then Roth deferrals are going to go back into this ESA account. And so hopefully we get some guidance or guidelines on how we do this. If not, we're going to have to figure out procedures on this switching back and forth between ESA Roth contributions and non-ESA Roth contributions. Also, there's going to be matching contribution issues, and hopefully we get guidance on here. So, for example, if a matching contribution has to be made on these ESA Roth contributions, let's say I decide in January to fill up my ESA bucket to $2,500, I'm going to get a match on that $2,500, but I can turn around the next day and take that $2,500 out of my ESA. And so I've put money in just for the purpose of getting a match on it, and then I've taken it out. So you can say I don't necessarily have skin in the game if I can put money in, and it just I can take it right out. So IRS is going to have to tell us what we do in those abusive situations where money's not staying in the plan but still getting a matching contribution on that. And then infrastructure issues, again, there needs to be a new source created in the plan that's a Roth source with different rules compared to other Roth sources. We got to figure out reporting W-2 stuff or 1099-R with dollars coming in and coming out of these Roth accounts. Disclosure, not going to go into a whole lot of information here. We need to provide disclosures 30 to 90 days before the first ESA contribution is made to the plan, as well as an annual notice after that. We're not going to go through the next couple of slides, but these are the details of what that notice needs to look like, basically describing what's going on with this ESA account balance. Next, effective 2024, really good news, especially for those folks who allow for example, immediate eligibility to get into a 401k plan. So little background here is that there are statutory eligibility requirements that need to be satisfied. So, for example, I can design my plan in a way that I can't require a participant to complete more than 1,000 hours of service in an eligibility computation period and or attain age 21. But more and more plans are letting employees participate in the plan before this year of service age 21 requirement, immediate eligibility. So when you let someone into your plan before they have satisfied the statutory requirements. They are called otherwise excludable employees. And right now, you have to make a top-heavy contribution, which is usually 3% of an employee's compensation. If you let these otherwise excludable employees into your plan, let's say immediately eligible into the plan, and they will receive a top-heavy minimum contribution, whether they defer or participate in the plan at all. So if your plan is top-heavy, then you would need to make this top-heavy minimum contribution to these otherwise excludable employees who are eligible to participate in the plan, but have not participated in the plan. They haven't made an affirmative deferral election. Well, that goes away with Secure 2.0. So our first example is what we were talking about. We have immediate eligibility. The employee, though, says, nope, I don't want to participate in the plan. The plan is top heavy. This employee gets a 3% top heavy contribution. In Secure 2.0, it goes away. So same example. This employee would not be entitled to a top-heavy contribution for 2024, even if the employee elected to participate in the plan. So not only do we not give a top-heavy for someone who doesn't make a 401k contribution, but if we let somebody in immediately and they do make a 401k contribution, we don't need to make a top-heavy minimum contribution to those employees who participate in the plan early, even if they don't participate in the plan, or if they do participate in the plan, and if the plan is top heavy. Next, hardship distributions from 403B plans, a little background here. So before Secure 1.0, if hardship distributions were available under the plan, for example, from the 401k bucket or the safe harbor bucket, and let's say, for example, I've got a $15,000 account balance in my 401k bucket. 10,000 of that was 401k contributions, 5,000 were earnings. Before Secure 1.0, I could only receive a $10,000 hardship distribution from the 401k bucket, my contributions. I couldn't receive a hardship distribution with respect to any of the $5,000 in earnings. Secure 1.0 changed that and said, hey, if you're in a 401k plan that allows hardship distributions, you can get to your entire 401k account balance, including earnings. You can get to your entire safe harbor account balance, including earnings, if you want to. But technical drafting error, they didn't carry over those rules with respect to 403B plans. So right now, as we sit in 2023, if I have a 403 account balance, my elective deferral account balance, $15,000, $10,000 is contributions, $5,000 is earnings, I can only receive a hardship distribution with respect to the $10,000 in elective deferral contributions that I made to the plan. I can't get to my $5,000 in earnings as we sit today. Secure 2.0 corrects the drafting error from Secure 1.0, and effective in 2024 for 403B plans, they will be put on equal footing with 401k plans, meaning if the 403B plan allows for hardship distributions, participants can get to the earnings portions of their elective deferral accounts as well as their safe harbor account earnings if the plan 403B plan is a safe harbor plan. Increased catch-up contributions for ages 60 to 63 effective in 2025. Background here, we know that if someone's over age 50, there's a normal catch-up limit. For 2023, it's $7,500. Well, beginning in 2025, what Secure 2.0 does in a 401k plan, 403B plan, and a governmental 457B plan, optional, not required, is increases that age 50 contribution limit for participants ages 60 to 63, and that the enhanced catch-up limit for these 60 to 63-year-old folks is the greater of $10,000, or 150% of the 2024 normal catch-up limit. So an example here, we'll go with the 150% because that's going to be greater. Let's assume that the 2024 catch-up limit is the same as 2023, which is $7,500. We multiply that by 150%. And so in 2025, that will be 11,250 for an age 60 to 63 catch-up. Now, here's a trap, of course, is that beginning at age 64, that participant would go down to the normal catch-up limit. So 50 to 59 normal catch-up limit, 60 to 63, this enhanced catch-up limit, age 64 and beyond, we go back to the normal catch-up limit. So obviously Congress could have just drafted this for anyone over 60 years old, but no, it's just this 4-year period, 60 to 63, then we go back down to the normal catch-up limit. Automatic enrollment plans are going to be required in 2025. It's going to apply to 401k plans and tax exempt 403b plans. The good news is, though, that if you already have a 401k plan in place, you do not need to go to an automatic enrollment plan in 2025. So for those folks that are here that don't have plans in place, let's go over these automatic enrollment plans that are going to be required in 2025. You're grandfathered in if you have a 401k or a 403b arrangement that was established before December 29th of 2022. So there's a potential trap here. Let's say that I have established a new plan in 2023 or 2024. It doesn't have to be an automatic enrollment plan in 23 or 24. But as soon as we get to 2025, it does need to be a automatic enrollment plan. That's because my 401k arrangement or my elective deferral arrangement and my tax exempt 403b plan, it was not established before 12/29 of 22. Also, new employers don't have to play by these rules for the first 3 years they're in business. But in that 4th year of doing business, if they establish a plan, they needs to be an automatic contribution arrangement. These rules also don't apply to governmental plans and church plans. And so that includes a governmental 403b plan. A small employer also doesn't have to play by these automatic enrollment rules. And the rule is that it doesn't apply earlier than the date that is 1 year after the close of the first taxable year with respect to which the employer maintaining the plan normally employed by more than 10 employees. Fight through that language, and here's what we're looking at. So we've got an example here. Our employer establishes a 401k plan in 2023. The employer normally employs 6 employees for the years 2023 to 2026. In 2027, the employer now normally employs more than 10 employees. So the close of the 2027 year is 12/31 of 27. We got a grace year to figure out what we're doing, which is 2028. That 2023 401k plan that was non-automatic enrollment now has to be an automatic enrollment plan beginning January 1st of 2029. What does it mean to normally employ 10 employees? Well, Congress could easily have told us what that meant, but they didn't. So unless we get some sort of IRS guidance, your guess is as good as mine. Do we take a snapshot on a specific date? Is it the highest number of employees during the year, or is it the average number of employees during the year? We don't know. The IRS is going to have to tell us. So, like all automatic contribution arrangements, the participant can always make a contrary election, say, you know what, don't put me in at 5%, put me in at 4%, or opt out completely. It needs to be an eligible automatic contribution arrangement. And what this means is that you need to offer these automatically enrolled folks an ICA with distribution option, meaning is that the first dollar that hits my 401k account that's automatically contributed there, and I look at my paycheck and I go, I wasn't expecting that. That's a surprise to me. You need to give that participant 90 days to clear out those automatic contributions out of the account. First year of participation needs to be at least 3%. In other words, our automatic contribution rate needs to be at least 3% in the first year of participation. Can't be more than 10%. We have to auto escalate in subsequent years by 1% each year until we hit at least 10%, but not to exceed 15%. We can totally avoid auto escalation if we just come out of the gate in that first year of participation with an automatic contribution rate of 10%. So first year at 10%, we don't have to worry about auto escalation. Anything less than 10% in that first year, we need to auto escalate till we get up to 10%. We can design the plan to go all the way up to 15% if we want. Which brings us to long-term part-time employees. And this is important for everybody. What Secure 2.0 did was it actually layered on top of Secure 1.0's long-term part-time employees without us having to work through the original Secure 1.0 rules, and you'll understand in a moment. So what Secure 2.0 says is that if you have an employee who completes at least 500 hours of service in an eligibility computation period, then that employee needs to be able to participate into the 401k portion of the plan or the elective deferral portion of the plan if we're talking about an ERISA 403b plan. So this is a required provision. It applies to 401k plans and ERISA 403b plans. So Secure 1.0 only applies to 401k plans, doesn't apply to ERISA 403b plans. And what Secure 1.0 did in 2019 was that if an employee was credited with at least 500 hours of service in 3 consecutive employee eligibility computation periods, they needed to be allowed to participate in the 401k portion of the plan beginning in 2024. And these are so-called long-term part-time employees. Now, we don't need to let our long-term part-time employees into the employer contributions portions of the plan, just the 401k portion of the plan. Now, here's a wrinkle. And if you are thinking about allowing these long-term part-time employees into your employer contributions portion of the plan, I would encourage you to talk to your Union Bank relationship manager, because here's why. Because your long-term part-time employees will have different vesting schedules if you let them into the employer contribution portion of the plan. So, for example, the plan has a 6-year graded vesting schedule for regular matching contributions. You've decided to be a nice guy. You let your long-term part-time employees not only into the 401k portion of the plan, but also to receive regular matching contributions. Well, all your other employees, your non-LTPTEs, they have to do 1,000 hours of service to receive a year of vesting service. But if you let your long-term part-time employees receive a regular matching contribution in this example, they will receive a year of vesting service with 500 hours of service. So you'll have 2 different vesting schedules depending on whether that person, that participant receiving the matching contribution is an LTPTE or not. So what Secure 2.0 does is layer on top of that, before we even worked through these provisions, is that reduces that 3 consecutive years to 2 consecutive years with 500 hours of service. We apply it to ERISA 403b plans in addition to 401k plans, and we ignore pre-2023 service for eligibility investing purposes for 403b plans, for ERISA 403b plans. We ignore pre-2021 service. So let's work through an example. We're in Secure 1.0. We've got a 401k plan. Our employee is credited with 500 hours of service in 21, 22, and 23. Remember, we ignore pre-21 for these purposes. So we've got our 3 consecutive years. We're playing under Secure 1.0. We get into the plan January 1st of 2024. Now we're under Secure 2.0, and it doesn't matter whether it's a 401k plan or an ERISA 403b plan. We've got 500 hours of service in 23 and 24. There's our 2 consecutive years. of 500 hours of service. So our employee is going to enter the plan on the 401k portion only, or the elective deferral portion only in our 403b plan on 1/1/25. Not going to go over this, but this kind of breaks it down with by plan, how it works with 401k plans as well as 403b plans. But let me give you an example here that you need to be watching out for, this interaction with your 401k plan with Secure 1.0 and 2.0. So now we've got an employee who has 500 hours of service in 21 and 22. The employee is credited with 400 hours of service in 23 and 24. Remember, we don't care what happens before 2021. Under Secure 1.0, it's a non-issue, because Secure 1.0, we need 3 consecutive years with our 500 hours of service. So no issue here, moot point. But under Secure 2.0, we do have 2 consecutive years in 21 and 22 with 500 hours of service. And so even though this 401k participant, this long-term part-time employee, wouldn't get into the plan in 24 under Secure 1.0, this person will get into the plan on 1/1/25 under Secure 2.0. No top-heavy minimums for this. 401k exclusions. Many plans exclude by job classification. For example, exclude interns. What if I exclude interns from my plan, but they get these 3 straight years or 2 straight years with 500 hours of service? We need guidance from the IRS to tell us, whether these interns can still be excluded. I think the IRS will come and say that we can still exclude interns in this situation, but I caution you to be safe and be prepared to include these interns in this example in the 401k portion of your plan. So if you have any job classification exclusions, beware and be looking out for IRS guidance. Also, plans frequently exclude part-time and temporary seasonal employees from participating in the plan. Again, we'll need IRS guidance on this, but I suspect that you'll no longer be able to exclude your part-timers from the 401k portion of the plan if they have these 3 straight years or 2 straight years of 500 plus hours of service. You can still be able to exclude them from the employer contribution portion of the plan, but I don't think these part-time exclusions will hold up. We will see. 403b issues, we don't have to worry about till 2025, and we're going to need some guidance on some of those exclusions in the 403b world. So with that, we're out of time, and I do want to tell you, I went over this fairly quickly, but again, it kind of tells us these slides back here, when we're dealing with a 401k plan or a 403b plan, what years we're going to count service for, and what years we're going to ignore service for with respect to that. So again, this is a slide from last week reminding you next steps. We don't have to worry about amending plans till 25, 27 if you're a government plan, but operational compliance is required. Until then, be looking for your operational compliance document, and then additional letters coming out here in the next couple of weeks. I've got an article in our current developments section that's talking about long-term part-time employees. So with that, I am done with my prepared remarks. If anybody has any questions, let me know. But as always, you can reach me by email or phone at any time if you have any questions afterwards. So I appreciate it. Thank you.
Thanks, John. So we'll take questions here in just a second. There's a couple questions in the chat box that I'll get to. Give me 1 second. I'm going to pause the recording here.